About 10 years ago, I was snow skiing as a dentist and I hurt my wrist. With two little kids at home, that was a big wake up call for me. If I can't use my hands, I'm screwed. So, an incident actually eventually led me to where I am now, investing in real estate, teaching other dentists, doctors, high income earners how important it is about real estate because you need passive income if something happens. And today, my guest is going to help us educate us from the metropolis of Orlando, Florida, Mr. Austin Hare. Austin, thanks for joining us.
Thanks for having me on the show today, man. I'm really excited.
Absolutely. So tell us a little bit, who is Austin Hare before we get going?
Oh man, that's a loaded question. Yeah, sure. So there's kind of been like four iterations, like Austin 1.0, 2.0, 3.0, 4.0. I'll kind of just give the condensed version, but I used to be a professional wakeboarder, so I was doing that when I was like started doing that when I was 12. Really focused on that a lot. When I was wakeboarding, I was able to attract roommates, and so I did what's called house hacking, where I bought a house and rented out the rooms and made money to live there. That kind of got me into real estate. And then at the same time, I kind of opened up some fitness locations and was doing like growing those by what you would call de novo. And I ended up buying another house, and when I'd go out of town, I would rent out the rooms on Airbnb, and because I was wakeboarding every weekend. And so I was like, oh, so now I was exposed to long-term real estate, and then I got exposed to short-term rentals. And then by doing de novos with my my fitness gyms, I got exposed to commercial real estate in the site selection process. And so I was in college at the time. So when I finished college, I kind of was wakeboarding and focusing on the gyms. And started working with my partner to help find a new location. We were ready to do our fourth location. And I thought in my head, okay, I'm going to go to Winter Park around Orlando. Like, this is the cool, sexy area. I'm going to stay away from Kissimmee. Like, these demographics are garbage. And we ran a really detailed analysis, and we found out, like, actually, Winter Park is super saturated. Rents are really high, tons of competition, and Kissimmee is wide open. And I just had no idea, because you can't make good decisions without good data. So I was really impressed with the process that they used for identifying sites. I worked with a number of brokers in the past. Nobody had ever gone in this much detail to help me find a good location. Well, I actually ended up having a disagreement with the franchisor. Thankfully, I ended up selling the gyms in 2019, right before COVID, so dodged that bullet. And then my partner invited me to start working with him full-time on the real estate side. And so I knew that I liked real estate from doing Airbnbs and the residential properties and stuff like that. And so we started working together doing site selection. And then oftentimes what would happen is we find a place, it's available. The landlord wants to sell, the tenant doesn't want to buy, especially when you're dealing with like private equity backed groups or hospital backed urgent cares or whatever it is in healthcare. And so the deals were falling through. We're like, well, why don't we just buy this real estate? And so that's kind of the genesis of how we started working together.
Awesome. So, and I know from different videos and meetings and that sort of thing that you do work with dentists, or you've had that, you've got some partners that may be some dentists, you do some syndications, that sort of thing. So from a dentist, from a doctor, from somebody that trades time for money, pays a lot of taxes, typically their investment strategy is invest with a 401k for 30 or 40 years with the financial advisor. What would you say about that, knowing what you know now?
Yeah, look, I am a proponent of investing in the public markets. I've got a portfolio as well. I will say, the returns through 401ks are often not as high as they argue or promote, because there are management fees, like a 2% management fee in an industry that averages 9% a year, like really kind of cuts into your returns. But that being said, the thing about real estate, I think it's a misnomer of passive income, because there's a lot of gurus that have said, oh, it's passive income, but it's not passive, it's reoccurring. So as an example, when I first bought a house and then I moved out and I had long-term tenants. Well, it was a house that it had 5-bedroom house. Well, all of a sudden, a couple of the guys stopped paying the guy who held the lease the rent. And so he was now saying, hey, sorry, I can't pay for these guys' rent anymore, but I'll give you my share, right? So then all of a sudden I was collecting rent per bedrooms. Well, then I never went over the property. I'd go over there and there was weights on the bottom of the pool, like workout weights that were just staining the pool. It was a lakefront house. The lake was totally overgrown. They weren't doing the lawn care. The drywall had holes in it. And so, there's just like all these things that I was like, this is supposed to be passive income. What the heck? Why am I having to do so much work? Every time a tenant would leave, and if I wanted to evict all of them, I'd have to get a new tenant for the whole entire property. So you're doing tenant turnover. You're doing even if maybe you're fixing the toilets and the plumbing and the drywall and all that kind of stuff yourself. Okay, great. If you're handy, hats off to you. But at a minimum, you're calling people to go out and do that. Or you have a management company they're charging 20% or 10% or whatever. And so it's not that it's good or bad. It's just that you have to know what you're getting into. And I think like for a lot of high income earners, like doctors and dentists specifically, you just have this tendency to think, well, like I'm making good money, and so I want to put it away into something's passive. But like if you try and do your own deals, it's just not as passive as you think it is. And so really what we've learned is like you kind of have to decide, like, am I going to invest passively, or am I going to take this on almost as a new career and focus
Hmm.
full, a lot of time and energy into learning this. And so you just really have to make the decision that's best for you. Like the question is like, how much time are you willing or do you want to spend into kind of learning this industry? Another example would just be, there's a lot of times we talk with groups who or individuals who really want to own the real estate for their practice. And it's honestly, if you're doing a single location, like that makes a lot more sense. That's great. But you have to understand the trade-off when you're trying to scale. So, we hear people compare, well, I'm throwing my money away with rent because I could be paying the mortgage instead. But what they don't account for with that statement is the down payment. And everything happens in trade-offs. Like nothing happens in a vacuum. And so, like, while it might be true that your rent might be very similar to what your mortgage would be, these days it's a 35% down payment. And so the question is, what kind of return are you getting on that down payment when you own your real estate that you operate in, or you operate your business in, versus investing in someone else's deal? And a lot of times you actually get better returns. Like, one example that I heard was, well, this person, he bought his real estate back in 1980 and he's paid it off and he's got these phenomenal returns. And that was the best thing he could have ever done. And I thought, really? Is it? Because I'm pretty sure if he had invested in Apple in 1980, that he would have got a lot better returns than he got on owning his individual practice. And so I only bring that up to say, like, it's so easy for us to look in a vacuum and decide, make decisions based on limited factors. And I think it's important to look at the whole entire picture. And so what we like to encourage people to do is think about, if you took that, like if you're an individual practice owner and you're thinking about buying your real estate, think about what else you could do with that down payment. And could you invest in another deal that is truly passive? Because if you are renting, then you remember the landlord is going to take care of a lot of the responsibilities for you. So if you invest in another deal and you continue to rent your space, then you could generate potentially higher returns and have less of a headache than you have to deal with a lot of the issues, the maintenance issues that come up in the building that you're leasing. So those are a couple examples. And then I think, does that answer all your questions?
So what you're saying, let me give you an example. Let's say somebody finds a building and it's $1 million that they want to move their practice, that they want to buy for their practice. And you're saying, instead of putting 35% down or 350 grand down and then still having the payment, which will be, let's say it's similar to the rent payment. If you were to rent that building, you could take that 350 and invest it into something else. Is that what you're
Yeah,
saying?
100% right. That's right. And you got to think, like, large portion of the rent is not going to increasing your net worth. A large portion of that is just the monthly expenses. So like you have you obviously have your triple nets, which is just like your taxes, common area, maintenance, insurance, stuff like that. Then you have your interest payments. You know what I'm saying? Like there's like only really a very small part that goes to principal pay down, which is the part
Mm-hmm.
that's increasing your net worth. Like most of the rent is not really increasing your. So it's like either way, whether you own or whether you rent, you're kind of throwing that money away. You know what I mean? And so yeah, like the question is like, what would you do with that down payment, like that money? And here's another variable to take into consideration too. Like we know people that are willing to take bad deals, meaning like they'll pay. They want to own the real estate so bad for their practice that they'll pay above market just so they can own and stop renting. And again, that's going to lower your returns versus like if you just pay market rent at a
Mm-hmm.
place, especially if the place is better, that's available for lease and you're getting good visibility. Now the fourth variable is how much traffic can I drive to my location by renting in a retail plaza that's going to get great street visibility, right? But then it's also, well, am I overpaying because I want to own? And then the third thing is, what could I do with this down payment that could generate? Is it going to generate a higher return than me owning the real estate? So I'm
Mm-hmm.
not necessarily saying don't buy the real estate. I'm saying consider all the variables that oftentimes don't get brought up by a lot of the real estate gurus.
Right. When I did financial coaching, like for dentists and doctors, the majority of them get out and they have a lot of debt, student loan debt. I had $300,000. Now it's probably average 500 plus $1,000. So we're in a lot of debt. And I always tell people whenever they start thinking about real estate, they immediately kind of like what you were saying, want to jump into, yeah, I want to own this house or I want to own this apartment or whatever. They want to be an active investor. And I said, look, your biggest wealth building tool is what you spend all your time, energy, and money on, your degree. And when you start taking time away from that, that's not only does your practice suffer, but then if you have a family, taking time away from them, as well, trying to go find a deal or having to deal with tenants or like you said, the weights in the bottom of the pool or mowing or or whatever. So, but there are ways that you can invest passively, and one of them being real estate syndications. And I know your group does some of that. So, for those that don't know what a real estate syndication is, why don't you explain that, and then kind of tell us some of the different types of syndications that your group does.
Yeah. So from the highest level, a syndication is just doing a real estate transaction. And you have what's called your general partners and your limited partners. So the general partners are also known as sponsors, but they're the people who do the work. They get it done. And the limited partners are the ones who put in the money. They're the investors. The reason that it's called limited partners is because they're limited to the amount of money that they invest. That's their maximum exposure. The general partners, on the other hand, are the ones taking on the debt normally. And so they have more exposure. They could lose more if they're personally guaranteeing the debt than the limited partners could lose by putting in the money. So you have the general partners and the limited partners. Usually, you're splitting the returns depending on the size of the deal. The more money that goes in, like the higher percentage that the investors get. But because there is a lot of work involved from the general partner side, especially when you're doing a new construction development. And so what that would look like specifically in our case is, we've got one of the problems that I'm sure you guys are seeing is real estate costs are just really high. Inflation is just driving up the costs like crazy. And so when dental users want to relocate or open up a new practice, there's not a lot of second generation of space available because not a lot of practices are going out of business because there is demand for it. So that means you have to build a new space. Well, a lot of developers don't like building multi-tenant spaces because it's just more risk. And so they want to do a single tenant one, but you have the least economies of scale when you do a single tenant new construction property. You're going to have the most expensive rent per square foot, bar none, especially retail, which is what a lot of people want, like these good locations. Mm-hmm. And so it kind of puts you between a rock and a hard place. So what's the solution? Well, my partner and I have been building relationships with healthcare groups and national credit groups for the past 15 years. And we will do multi-tenant developments where we leverage our relationship with the retailers, large national retailers, in order to bring them in paying the retail rent. And then we can have our healthcare users pay a little bit less, and we still make great returns for the investors. So everybody can win. So like as an example, we had a deal that we did out in Lease Summit, Missouri. We had a urgent care that told us they wanted to go to this specific trade area. We were monitoring it for years. Finally, something opened up. We got a Bank of America building under contract, and then we had our urgent care only wanted half the building, so we had to search for somebody else. Well, this is one of the first deals where we made a relationship with Starbucks. So they gave us an LOI, and then all of a sudden the urgent care backed out. And so now we were stuck like, oh gosh, we got to close. We don't have a signed lease from Starbucks. The urgent care hasn't signed, or is not going to go through this deal. Like, what do we do? The seller was at their wits' end because we had been delaying because of the urgent care. We decided to take the risk, bite the bullet, and do it. So we did. We closed. Sure enough, Starbucks signed the deal. And like I said, we've been monitoring that area for 2 years, doing our demographics, doing our analytics. Like we knew it was a strong area. And then we found a 90-unit physical therapist operator. And so that was kind of like a testament to what can happen when you fall, like how good your deals can be, your returns can be when you follow the fundamentals, because we're averaging 20% returns on that building. But the point being, we were able to offer our healthcare user a little bit lower rent because we got a national retailer in, and we're still making great returns for the investors. So that's kind of been like the business model is like, we've done deals with Panda and Starbucks and Chipotle and even AutoZone. And so a lot of times these retailers will really help juice like the deal. And then we can still get our healthcare guys in at a decent cost. So that's kind of what we mean by syndication. So we're going out, we're finding the tenants, we're finding the deal. In that case, we were redeveloping it, meaning like we hired the general contractors and we put in the work. We had to repave the parking lot and redo the roof. There's a lot of issues, and then a lot of landscaping to meet the city code. I mean, there's a lot to it. Not to mention entitlements and stuff like that. But that's what the general partners do, right? In addition to taking on the debt. And then the limited partners put in the money, and that's mailbox money. Because like you were talking about a second ago, Jeff, most people are busy, right? Like you're working, which you should be. Like, what's the best value of your time? Is it scouting deals? Maybe. Or is it going to be going to work and operating and sitting in the dental chair and, getting those high hourly rates? Like for most dentists, like your best use of your time is going to be sitting behind the chair, and then you want to take that money that you're earning and diversify it so the way that you can have safe streams of uncorrelated income that come in.
So walk me through the typical, let's say a typical limited partner that invests with your group. Like maybe what's a minimum investment? What type of asset class would it be? what's the kind of the payment look like, the exit look like, more of like a high level? What's that look like in your
Sure,
group
yeah.
with your group?
So we have a couple different groups that we work with where we develop projects, like around, call it 5 to 8,000, maybe 10,000 square feet, where we'll be using a healthcare user that'll kind of give us the assignment. And then that cost is usually around $3 to $5 million. And that means that we would be taking on bank debt for 2/3 of that, and we would be allowing limited partners to invest for the remainder of it. So, as an example, we're working on a deal, it's 8,000 square feet, and we've got it's about $4 million is the project cost total. So we'll accept about $1.4 million from investors, and the minimum, to your question, is usually $100,000, and then when it's stabilized, it'll be worth around $1.2 million, and a lot of times we like to hold on to that deal. So we're creating about $1 to $1.2 million worth of value, and the GPs are splitting the upside with the LPs, and then we're looking at about we're targeting 18% IRR for the investors in a case like that. Does that answer your question?
So do you pay any type of distributions along the way, or are you waiting until the end to when you exit?
Yep, every deal is structured a little bit differently, but we do pay distributions. So in the deal that we're working on right now or outside of Orlando with the large retailer and a dental group, the way that we're structuring that is we have an 8% annual pref that's accrued by the investors until a capital event. And we define a capital event as a refinance or a sale. In this particular case, a lot of the dentists are funding most of the equity required. So there's not a whole lot of room left for other investors, and they prefer to hold, which is actually our preference as well. Now, the reason in this particular case that we're holding, and a lot of times we like to hold, is because if you look at a real estate syndication and you think about selling versus holding, when you sell, the better your IRR is going to look on paper because you're shortening the time period. So that's all true. However, there's two things. One, you're going to owe capital gains taxes. Maybe it's short term, maybe it's long term. The other thing is there's an opportunity cost for that money. So you did some due diligence before you put the money in, and now that you've sold it, your money's going to be sitting on the sidelines for a period of time. I don't know how long, but there is a period of time. And so our preference, the way that we look at it in building wealth for our families, is just like, well, if we have an asset, a real estate asset, and we hold it and refinance it, well, we're now taking that refinance is giving us cash to reinvest as we see fit, and we can hold that asset indefinitely and allow the equity to improve. Like every time you have a rent bump, the value of the building is going to go up. And so we're allowing the asset to appreciate. We're building equity. We're using principal pay downs. It's a get rich slow scheme, as I like to say. But you're not going to get as much money from the refinance as if you sell it, but you're not going to owe taxes either. And then also there's no opportunity cost. Like your money is going to be working. Like you're going to retain your equity position in that building as it continues to improve over time. And you have debt pay down and annual or what we call it quarterly distributions from the cash flow from the rent. So that's kind of our preference. And so the way that that's structured would be we would have a 8% preferred return to the investors, which just means that they get the first 8% no matter what, and then until the refinance event. And so in this particular deal at the refinance event, we're targeting a 59% return of capital. So if you invested 100 grand, then after a year when the asset is stabilized, would refinance, get 59% back or $59,000. Plus, if it's been a year and a half, you would have gotten 8% annually. That'd be 12% or 12 grand. So the 59,000 plus the 12,000 would be $71,000 that you get within the first year and a half of investing $100,000. Now, the trade-off is when you do refinance, obviously, you're going to have more debt and your cash flows are going to go down, especially in the high interest rate environment. So cash flows do go down a lot from monthly distributions. But remember, you just got a huge chunk of that money back up front. And then the year 5 mark, the goal will be to refinance it again and return the rest of the equity. So in this case, 41%. And then that way, if you've essentially gotten your entire original investment back, you've got a 12, that your 8% pref or 12% return, and then you've been collecting a little bit of annual cash flow. And now you're still going to be the asset owner. You're still going to maintain your original equity position to be what we call phantom equity because you've been paid back, but you continue to collect rents indefinitely in the future until or if we ever sell the asset one day.
Yeah, and I think that's a different mindset shift, investing mindset shift that we have to have because we're taught, and I started with the Dave Ramsey method, and that's where I got the name of the website, Debt Free Doctor, because he was completely get out of debt, which I agree, to get out of student loan debt, if you have any credit card debt, consumer debt, high consumer debt, but never take on any more debt, whether good or bad, and do the 401k accumulation method. So when you think about that, you're always thinking, okay, I have to make more, I have to accumulate more and more. And then when you get to the point where maybe you got like 3 to 5 years left of practicing, always in the back of your mind, it's like, do I have enough to retire? What if the stock market, what if I want to retire next year and the stock market's down? Do I just go another year? So it's always in the back of your mind versus what you're talking about and what I'm talking about in videos and articles, and that's the cash flow method. Getting, in your case, you're getting that cash flow back now. You're replacing that active income, and you look up in 7 to 10 years, if you're consistent with it, and most dentists can afford to do this, 7 to 10 years, you've got 6 figures of passive income coming in. Really, truly passive. What you're talking about, and and the tax benefits of that income. It's taxed a lot less versus dental income. So that's, to me, that was the hardest thing for me, because I had to unlearn everything I've been taught about investing money. Now, do I still have money in the stock market? Yes, because that first 10 years, I put it into index funds and that sort of thing. But now moving forward, it's differently. So is that kind of what you're recommending or what you're seeing when you're working with dentists?
Yeah. So I mean, you made a couple points in there, but the to your point, the stock market is volatile. Like, yeah, I agree with you. It's great. Over a 20-year period, the stock market has never lost money. But the shorter your time window, the more volatile it is. So if you're planning on retiring in exactly 6 years, we have no idea what the market is going to be like in 6 years. So the thing that I like about real estate, or at least I should say about having both as an option, would be the consistency of it. When you get a tenant in there, especially a credit tenant, signing a 10-year lease, you're guaranteed, as close as you can be to guaranteed, having that income every single month. And so despite like a bankruptcy, right? Like, you got to ask yourself, what's the odds of like Panda Express going out of business, or Starbucks, right? It's just very, very low. And that's your downside risk, because you've got a physical asset that's going to have value no matter what. It's not going to go to zero. It's just, it could be unoccupied. And even then, it's a very, very, so like, my partner and I, when we started working together back in 2019, we sat down and, we could have gone to any asset class in real estate, really, like any real estate asset class. And we specifically targeted healthcare because it's got the lowest, we call it RPI, recession resistant, pandemic resistant, inflation resistant. And so I'm sure everybody, watching this video already knows that, but it's got really, really safe and secure, like it's got a really great risk return profile. Like the risk is just so low. So that's why we specifically targeted it. And according to the SBA, I mean, dentistry's got like the lowest default rate out of almost any business. And so it's a very, very safe way to invest your money. And it's, if you're spending your time doing the highest and best use, like making the highest and best use of your time, which would be, chairside operating, etc., then you want to invest your extra money. You want to save some money to invest in something that doesn't take up any of your time. And so, in our opinion, of course we're biased, but like we think that one of the best things that you can do is invest in healthcare backed real estate, and real estate that's backed by credit-worthy tenants, just because the risk return profile is so great. And then to your point, yeah, now you've got your money working for you. It doesn't require any of your time. It's literally, when you're a limited partner, it's literally mailbox money. You get your quarterly distribution wire transferred to you, and that's all you have to worry about. And so, yeah, you can continue to collect those checks every quarter, indefinitely, really, until you sell the asset. And then at that stage, you're going to have another chunk of capital. So, yeah, I think that's what you're trying to say. And if so, then yes, I'm in agreement.
Yeah, and it, like I was mentioning, if you just, the problem that people have is they'll do this once and then they won't do anything for 3 or 4 years, and then they'll email me and go, Jeff, well, I'm not really getting any closer to my goals. And I said, well, how many syndications have you invested in? Well, I did one 3 years ago. That's it. You have to be, it's not a like you said, it's not a get rich quick thing. It's a get rich slow, but not as slow as the typical way 30 or 40 years. So you just have to be consistent with it.
Right. And to your point about doing one syndication, that's why we like to refinance as soon as we can to get a lot of the investor cash back, because now you can take that money and you can do another syndication. You can keep making that money work for you.
And Grant Cardone is always talking about this point. It's called cash flow for a reason. It has to flow. It has to continue to circulate. Sitting in a bank, it's just dead weight, because as soon as you go to the bank, whether you believe it or not, and put your money in a checking account or savings account, guess what? It's gone. They're lending it out. they're not letting it just sit there, you know. So they're lending it out at a much higher rate and, you know, paying you pennies on the dollar.
Yeah, no, it's true. Yeah, they have the fractional banking system is what we have. You know, they only
Yeah,
have to hold less than like 10% in reserves. Maybe it's even like 3% or something like that. Yeah, so they know they're not letting their money sit there the same way. Nobody listening on this call should be letting their money just sit there in your bank account. I mean, maybe a small percentage as like your emergency fund, but like, you know, a couple months worth of expenses. But for the most part, like we know at this stage, I mean, inflation was at 9%. Now it's down to 2.5. Even at two and a half, compounding inflation will kill you over 20 years. You know, like literally every day your money has less purchasing power. So yeah, I mean, I'm definitely an advocate of keeping your money invested into something. And especially like the older you get, the less risky you want to do. So there are deals out there that are, they have like these high 30, 40, 50, 100% returns. But like the higher the return, like the higher the IRR, the more risk that's associated with it. So we shoot for these very, you know, safe 18% as our targeted IRR, and we've averaged about 20% with our investors. And so that's what we shoot for. It's like, it's really good. It's way better than the stock market, but it's also got a great risk return ratio or risk return profile. So that's kind of our sweet spot that we stay in, so that we can, you know, Warren Buffett calls it return of capital before return on capital. You want to make sure that you're getting your money back, right?
that's right.
And so that's just important for anybody when you're doing your due diligence stage.
All right, last question. I'm going to put you on the spot, okay? All right, looking back over in your career from where you started to now, what's the top influential book that you read that really changed the course in your life, and why?
I feel like a lot of people say Rich Dad Poor Dad. You know, have you read that book?
Oh yeah, multiple times.
Yeah, so it's like it's almost like a cop out answer, but I mean that was, I mean, I read that book when I was 18. I just got to college, you know, left home, and you know, that's when I started house hacking. That's when I started renting rooms and renting. I would sign the lease to houses, and I would get people to rent the individual bedrooms from me, and I would charge a premium in order, because I was taking on the risk, and then my goal was to offset my rent and live for free, which helped me.
What in that book? What specifically in that book? I know there's a lot of lessons, but was there something specific in there that changed your investing
Well,
philosophy?
he talked about passive in investment in real estate, passive, and I mean, like now I know passive is on a spectrum, but yeah, it was a passive investment thing. It's like, okay, yeah, like I got to stop trading my time for money, you know,
Hmm.
which again, like that was a an oversimplification of it. It's just how do you get more leverage on your time is really a better way to look at it. But that motivated me, right? Like, okay, so if I get roommates, like if I go into real estate and I get tenants, they're paying me every month the same thing, regardless of how much time I spend. So, you know, it was essentially getting out of that mindset and getting into the business mindset. So, like, you know, he has four quadrants: business, employee, self-employed, business owner, and investor. And so, investor would be what we consider the LP and what we just talked about. Employee would be, you know, let's just call it an associate. Self-employed would be you own your dental practice and you work every day. And business owner would be you own it and you have a bunch of associates. You know, so that's kind of like how it works around the spectrum. So like seeing it in that term, because at the time it was like, you know, I'm a business owner, like I'm a professional wakeboarder. Well, I have to go physically do these things. Or I was coaching at the
Hmm.
time, right? Like, oh, I'm a business owner, I have a wakeboarding school. Well, I'm coaching people, like I'm really self-employed, you know. So it was like learning the difference between self-employed versus trying to get more passive investment, trying to get more passive income.
Yeah, yeah. The cash flow quadrant for me in that book, that was my biggest wake up call in quote how I was making money, because as a dentist, when we get out, most of the time we're associates, and then kind of the goal is like, hey, we want to own our own practice. We want to be self employed. And for me, when I bought my building and started my practice, you know, I thought, hey, that was it. But you know what? I read that book again, and I'm like, okay, I'm still trading time for money, like when I was an employee. I'm still getting taxed at the highest rate, and I can't take any time off. You know, it's not that dentists can't afford to go on the week vacation. It's like we can't afford to be off any
Mhm.
longer because payroll, overhead, expenses, you know, that, unless of course, you know, you're on the right side, you're a business owner with multiple associates. But my goal was to get to the I quadrant, that investor quadrant, where your money is working for you. And it was funny. We were at Lake Tahoe 4th of July with my family, and we had gone out and did this excursion with boat and did all this stuff. And the bill was like, that came for that day, it was like $2,100 and change or whatever. It was so funny because I was getting ready to pay it, and I pulled up my email, and I'd just gotten a distribution that day from an RV park that covered it. And I told my kids, I was like, look, you know, here we are, when we just had something, an asset where I didn't have to trade my time for money that paid for it. And I'm trying to teach them to get into that mindset.
Yeah, that's so funny. It's ironic that it was the exact same amount, but
Yeah,
that's the
it was.
truth of it. Yeah, your
Yeah,
money is when you're investing, and an investor, your money is working like all the time, 24/7, regardless of what you do. And I think
yeah.
that's really powerful.
Well, I really appreciate your time today. If people want to learn more about you, your projects, your syndications, tell them where to go.
Yeah, leadersre.com, so www.leadersre.com, the RE as in real estate. And then hit me up on LinkedIn. I'm pretty active on LinkedIn. I'm posting all the time. My name's Austin, like the city, hair like on your head. But yeah, I post on there and I'm active, and shoot me a message, and we'll see if it makes sense to work together.
Awesome, and I will put those into the notes below this video. Thanks again for your time, and take care.
Thanks, man.